It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Traders awaiting a U.S. jobs report that could flick the switch on a jumbo Fed rate cut this month. Trading cancelled in Hong Kong due to Super Typhoon Yagi. Also ahead, India's hidden jobs crisis, how a lack of quality roles for highly trained graduates poses a risk to investors betting on growth.
And I'm Stephen Engel in Shanghai at the Bund summit, where former PBOC Governor Yi Gang has made a rare admission from a former senior official here in China that the nation has a deflation problem.
Well, ahead of that U.S. jobs report, we got markets kind of drifting here in the Asia Pacific. Avril Hong's in Singapore with a closer look. Avril.
I think drifting is the right word to use. I mean, we're not seeing a lot of momentum or conviction ahead of that all-important U.S. jobs data, which will determine whether these bold bets by some of outsized rate cuts from the Fed come September will actually have a case. And amid all this, the Asia stock gauge sitting pretty flat. In Japan, we're also seeing a bit of a mixed bag. As the yen rallies amid the softer dollar, we are seeing the export-related counters taking a bit of a hit. And in terms of some of the other markets that we are watching very closely today, certainly we're seeing Thailand coming online. Just a day ago, the stock benchmark managed to climb by the most since 2020 as some of these policy risks fizzle out, and it seems to be extending those gains today in the early part of the trading session. As I say, it is a backdrop of a soft dollar, so look at where we're seeing the yuan and the Japanese currency. Now, I'll flip the board because noticeably absent from that board is the Hang Seng, and that is as Super Typhoon Yagi skirts the city. We're going to see trading cancelled for all of today. The T8 will be in place until 12:40 p.m. And as you can see on that screen there, that just means that the afternoon session will also be cancelled. Flip the board again. Let's take a look at what swaps are pricing in terms of expectations of what we'll get from the Federal Reserve. The base case by most is that we get a 25 basis point cut in September. We're seeing swaps pricing in a little over 30 basis points, but we also have these bold bets by the likes of JP Morgan, by Citi, that we're going to see a 50 basis point move. And this just speaks to the split in expectations, which means that whatever way the data swings today, we could see huge moves in treasuries trying to adjust to that. Flip the board again and get you up to speed with what exactly forecasters think the data will show us. Non-farm payrolls estimated at 165,000 in terms of the change in NFPs. Jobless rate could edge lower to 4.2%. There's a lot of ground to cover. Our next guest says she's focused on the U.S. unemployment data to see if any major weakness could prompt an outsized Fed rate cut. Let's bring in Yulia Alexieva, MD of Global Fixed Income at Barings, as well as Bloomberg M-Life strategist Mary Nicola. So Mary, let's start with you first. What are you looking at in terms of the data? What looks normal at this point in the cycle?
You know, it's interesting because if you look at what we've seen from, let's say, ISM overnight, and it actually shows that ISM services is holding up, so the economy looks like it's heading towards a soft landing. Of course, at this stage of the cycle, you won't see as much of a rapid hiring as you would have expected a few months ago. But again, it's not like we're seeing things are falling off a cliff or signs of a recession, because the U.S. consumer is holding up relatively well. But still, it's the fact that Jay Powell at Jackson Hole put the pressure and put the onus and the fixation on what we're expecting from payrolls. So now everyone is glued to that screen at 8:30 on Friday morning to see what happens and what comes of it, because that will determine whether we get a 50 basis point cut from the Fed or a 25 basis point cut.
Yulia, your base case is for a soft landing, but that's not guaranteed. What do you expect out of the data?
Yeah, we're definitely in a soft landing camp scenario. This has been our baseline and center case basically for a while after we have surpassed the Q1 weak data. And I think at this point, when we look at labor market, which I think everybody has their eyes on, we do not expect any sudden deterioration. We actually believe we're going to be in for gradual cooling, so no sudden collapse, no major shocks. And I think if we take a step back and look at unemployment, we are actually benefiting from a relatively low unemployment backdrop, whether it's 4.2% or 4.3%, anything in the low to mid 4% area is not a spooky number to us by any means, but similar to what Mary mentioned, we are glued to see what August employment report will bring. And I think it is important for various reasons, because this will really decide the destiny, whether we're going to have a 25 basis points cut or a 50 basis points cut. And so strong numbers will lean us towards 25. Soft numbers will put us more in the 50 basis points category. And so between these two alternative realities, we at Barings believe 25 has a higher likelihood of playing out.
Yulia, if we do have that other scenario, though, which is a live one, and we do end up with 50 basis points, what sort of signal do you think that sends? Would it send a signal that perhaps the Fed is panicking? And we saw that the Fed was criticised for being late to tighten. Would they face similar criticism about being late to ease?
Yeah, absolutely. That's a concern of ours. And I will say we have been higher for longer. And the side effects is something that I think is top of mind for a lot of investors. What we are seeing is that weaker business models and also more rate sensitive sectors, think commercial real estate, for example, are exhibiting signs of vulnerability because we have been in this less forgiving rate environment for several years. And so what that means from our perspective is that we're going to see potentially increased bankruptcies and defaults if the Fed does not do a good job of easing and easing sufficiently and rapidly enough to get us to a soft landing scenario without breaking anything along the way.
Mary, I just want to ask you what we're reporting in terms of what the market is pricing in around the jobs report and Fed expectations off the back of that. And is the scene really getting set up here for quite a bit of volatility in risk assets?
Yeah, so it looks like the market is pricing in about roughly 35 basis point cut for September, but it's more about what they're pricing thereafter, and that gets a little bit more aggressive. But I think one thing we have to keep in mind is when the Fed said that inflation was no longer transitory, they still only hiked by 25 basis point cut, by 25 basis points, showing that they're likely to take more of a cautious approach. That's been the approach Powell has given us, whether it was 2019 when he started cutting, whether when he started hiking this time around. So it looks like, in line with what Yulia said, I'm probably more biased for a 25 basis point cut than a 50 basis point.
Mary, when it comes to the data, as you alluded to earlier, there is this fixation with every single data point. I think part of it also speaks to how, there's not a very clear picture as to where jobs is concerned. But also, do you think this is a sense of when we are transitioning from focusing on inflation to employment, just difficult in terms of prediction? Is that something that we should be accounting more for as well?
I think it has a lot to do with the fact that the Fed has made everything data dependent, and that's why we've become so fixated on every single data point. So if it wasn't this employment report, it would have been next week's CPI, and even if the employment report comes in relatively in a Goldilocks scenario, then we all switch our focus back to CPI. So it's really because of the fact that there isn't that sense of understanding of where the Fed is headed, and because they've made everything data dependent. And so that's why you get these large swings in the market, and that's going to continue until you get a clear path from central banks saying, here, this is what our intention. And sure, we have the dot plot, but it still says everything according to the dot plot still remains data dependent.
Yulia, I'm curious, what is your investment strategy until we get that clarity from the Fed?
Yes, Avril. So the way we think about it is that soft landing scenario is positioning fixed income to perform well. And so against that backdrop, as we're thinking about our positioning, throughout the year, we have been shortening spread duration and moving up in quality just to be more defensive. But in terms of a more specific manifestation of where we see best value and really highest conviction trade idea in the market, I would have to name securitized credit. And that's an area where I think it really shines bright today, because if you look at the investment grade corporate spreads as well as high yield spreads, they're at historic tight levels. But within securitized credit, specifically within asset-backed space, we're still able to find durable income and compelling yield-enhancing capabilities to support our strategies. And I have been spending a week here in the region talking to a wide variety of investors, and what I heard from them really is that they remain largely underexposed to asset-backed securities, despite the benefits that they provide in terms of investing, including diversification, as well as embedded structural protections, which are important as we are in this late cycle, potentially pre-recession type of environment. And so right now, when we look at the asset-backed spreads, we think they provide an attractive risk-adjusted return versus conventional fixed income. If you look at valuations, we are about 30th to 40th percentile versus long-term history. So we are closer to historic average rather than historic tight. And as an extension of that, I should mention that we also like private securitized opportunities for investors that do not need ongoing liquidity, but that do want to benefit from a compelling premium that you can get in terms of illiquidity and complexity premium, and get compensated for that as well.
Yulia, in terms of recession indicators, we had a really long period of the yield curve being inverted. Now the 2s, 10s are showing signs of disinverting, and it has disinverted a couple of times over the past few days. We've been having a bit of a debate here over whether it means anything or whether it means nothing. Where do you stand on that?
I think we have been waiting for disinversion for quite some time, right? The 2s, 10s actually flirting with a flattening is endearing to us. I think its normalization is how I would classify it. It's not something to be alarmed about. And I think philosophically, if you think about where we stand, it's more of a glass half full, that we can march on in a more controlled fashion, where there is some predictability in the market, and where we know how to basically make investment bets. Because admittedly, when we were in a negatively inverted scenario and at a certain point reaching negative 100 basis points, it was hard to understand whether good data is bad data or good data or the reverse. And so I feel that right now we are returning back to normal, back to sort of classic fundamental investing in a sense of the word.
Returning to normalcy, that is music to the ears of some, I guess. Thank you both for coming in and sharing your insights with us. Great to have you ladies in the house. Speaking there with Yulia Alexieva of Barings and Bloomberg MLife strategist Mary Nicola. Paul?
Still to come, we are live at the Bund summit in Shanghai. We're going to discuss central bank policy with the former governor of the Bank of Israel, plus the AIIB president, Jin Li-kun, is going to join us later in the hour. This is Bloomberg.
Let's get back to Shanghai, where the annual Bund summit is getting into high gear. Our chief North Asia correspondent, Stephen Engel, is there with our next guest. Steve.
Hi, thanks so much, Avril. Let's get to our next guest. It's Jacob Frenkel. He is the former governor of the Bank of Israel and also the chairman of JP Chase International. Thanks so much for having us here at this summit where you are participating, obviously. Let's talk about the Fed to begin with. Some are saying that they're going to act too late, that they should have been cutting sooner. What do you think?
Well, I think first of all, looking forward, it seems that they are on track to achieve their objective. And indeed, as Chairman Powell indicated very recently, they are going to start the path of lowering rates. It will not be a dramatic change. It will be a start of a modest
25
area.
basis points, 50? It depends on the job report we're going to get later.
Well, of course, the Fed is data dependent, but by and large, we have to realize there is a lot of uncertainty in the world. And there is a theorem that you don't run into a dark room. You go step by step. And I think that the reality is that the Fed definitely would not like to be in a situation where it takes a step and then it needs to reverse itself. It'd rather go a modest amount and then look around, move on, etc. So I think that indeed the 25 basis point is in the cards for the coming call.
How much visibility do you have beyond September, beyond this month? Obviously, there's, 2 more after this year and then into 2025. John Paulson was saying the Fed fund rate could go down to 2.5% by the end of next year. Would that be too aggressive?
I think it will be probably unhelpful today to start playing this game, because if you ask the very same question 2 years ago and a year ago, you would have realized how much futile it is. I think that what is important is to identify and recognize that the Fed has charted the way in a very clear way, and indeed we are as close as possible to what is called soft landing. And remember the volatility of expectations in the market. It will be a crash and it will not be a crash, etc. There is something, however, to note, which is in the past, and lessons need to be learned. In the past, it seems that the Fed and everyone else acted a bit too slowly. They raised rates maybe too slowly, and they lowered rates maybe too slowly. And the argument is, was it just poor forecasting, or is there something intrinsic? And I believe there is something intrinsic, that in the current circumstances, monetary policies, as the way they are designed, have a built-in mechanism to be behind the curve, because they are so-called data dependent.
Right.
And until they see things in the data, they would not move. And I think that we are now realizing more and more that to look at the picture through the rear view mirror may be costly if the road is not straight, which means you need really to develop an anticipatory mechanism. So when the Fed, we don't need to be data dependent, we need to be expected data dependent, and that's where the professional challenge is. Design the expectations properly.
Do you have any hot takes on what the ECB, because the ECB and BOJ and the Fed all reporting or are going to have their monetary policy decisions within about a week of each other, some within days of each other. BOJ maybe has been very cautious as well for a long time, and now we've seen, though, they've started raising rates. The Fed is going to start cutting rates. That yield differential is narrowing. The yen carry got unwound. Do you think there will be a more cautious approach going forward, or more aggressive on tightening with the BOJ?
No, I think that first of all, the European Central Bank will also follow a very similar trajectory, and we will see it will look in retrospect as a coordinated move, but it's not. It's basically sharing the same view about the system, and the system is integrated. And I think this whole game of decoupling and deglobalization and everything is fundamentally a mistake, because we should not lose the benefits of open markets and globalization.
Let's talk about Israel, because obviously the war continues there. What do you think will be the lasting ramifications on the economy? We've just saw the first downgrade for the first time ever. I mean, still, the investment grade pretty much is still in place. But Israel, what do you think will be the outcome from the ongoing skirmishes with Hezbollah and the war in Gaza?
So it has two dimensions. Question number one is, what is the politics of it? And second, what are the economic consequences? And they are interrelated. In the past, Israeli economy has recovered very quickly after small, short wars. Very, very quickly. And one of the reasons is that the Israeli economy is fundamentally very strong. It has a very strong tech sector, and technology is really the jewel in the crown, and the human capital is there, the markets are there, and the war has not been too disruptive about it. There are sectors that the war has disrupted, whether it is tourism, construction, we don't have labor, or the Palestinian labor force that was used to be employed in Israel. So this is a disruption. But now when it comes to the understanding of what the process is, I think it's important to recognize that the issue is not just a bilateral issue between Israel and Hamas, but rather it's a much more global, bigger issue that involves Iran. What is happening here, as you know, Iran normally operates through its proxies. And there are three proxies here: the Hamas in the south, the Hezbollah in the north, and the Houthis from Yemen. Now, the Houthis have had implications on global marine navigation. And this is something which is very important. So therefore, I think it will be a mistake to cast it as an issue between Israel and the Palestinians. And I think the Palestinians in this particular case are themselves, quote unquote, victims of their affiliation and association with the Hamas, because basically we were on the verge of progress with Saudi Arabia.
But when do you and how do you see the war ending?
Well, there will need to be a resolution very, very quickly. The urgent matter now has to do with the kidnappers that needs to be resolved. They are dying on one after the other, and it unites the Israeli population completely of saying this is the main objective today, to get them out. In addition to the human issue, there are here also very fundamental geopolitical issues. How will it end? I will not be able to forecast to you, but I can tell you one thing. It will end. The first step is the hostages. The second is to recognize that the potential of a Middle East that is prosperous, that Israel can export its technology, whether it is in the irrigation or or water or health, it is an extraordinary tragedy that the neighboring countries are not in a position to enjoy these benefits.
Jacob Frankel, we could go on, and I wish we could. I wish there were more time.
All the very best.
Thanks so much for joining us here at the Bund Summit. Back to you guys from Shanghai.
Thanks so much, Steve. Now we'll have more from the Bund Summit in Shanghai. The AIIB president joins Steve, to be specific, later this hour to discuss climate policy-based lending and his macroeconomic outlook. This is Bloomberg.
Let's take a look at the oil price. We've got Brent right now climbing a little bit, but emphasis on the little, 72.69 a barrel at the moment. Brent, though, heading for one of its worst weeks in quite some time, down about 8% for the week. West Texas Intermediate hovering near 69, and OPEC Plus saying it's not going to boost output by 180,000 barrels a day in October and November. Take a look at EV suppliers in China, though. They're doing pretty well. This is on the news that the automaker plans to launch its advanced driver assistance system in China and Europe in the first quarter of next year. That does rely on regulatory approvals, though, and we have seen these timelines slipping in the past. Gains, though, at the moment for those EV suppliers. Plenty more ahead. This is Bloomberg. We've got China markets just heading off to lunch, and after some gains early on, well, CSI 300 now back into negative territory, off by about 0.25% right now. We do have the index heading now for its worst week since July, and if we close lower today, and it looks like we might, so that'll be a 3-week-long losing streak for the CSI 300. Risk assets more broadly, though, seem to be drifting ahead of that crucial US non-farms payroll report. Well, China is combining two of its largest state-backed brokerages to create a new industry behemoth. For more, our China correspondent Minmin Lo joins us. So, Minmin, tell us more about this deal.
So this is a merger between Guotai Junan and Haitong Securities, both of which are partially owned by Shanghai State Assets Administrator. This is a deal that is still pending regulatory approval as well as approval by board members and shareholders. They're going to merge through a share swap. And if this goes through, that would take the total assets of these two companies combined to 1.6 trillion yuan or $230 billion. That puts them on top of CITIC Securities to be the biggest brokerage in the country. And this deal is coming about a year after President Xi had urged regulators at a financial conference to really shore up the industry, to nurture top-ranking investment banks to compete with Wall Street banks that are expanding into China after Beijing had liberalized the sector to allow full foreign ownership in 2020. So analysts are expecting more mergers and acquisitions to come as companies vie for those top 2 to 3 spots in terms of brokerages that policymakers will prioritize to compete with global peers by 2035. At least that's the goal that has been set by the securities regulator.
And this also comes as the sector has been hit by a profit slump.
Yeah, so this sector has really been in the doldrums for years now. If you look at the Bloomberg index of the 25 brokerages listed in mainland China, that's down, 25% in the last 5 years. You have the stock market floundering on a weak economy. You have earnings not looking very bright. If you take a look at CITIC Securities, they are down. They reported decline in the first half of this year. Same thing with Haitong as well. That's down 75% in the first half. And this sector was also targeted by President Xi's Common Prosperity campaign that led to some banks asking employees to take a haircut on their salaries. But still, this is a sector that has 145 brokerages as of end of last year. So there's a lot of room for consolidation, especially given that China is the second largest stock market in the world, and yet its brokerages really lag far behind global leaders. If you take a look at that chart we showed earlier, Goldman Sachs and Morgan Stanley has market caps of above $160 billion, but CITIC Securities, for example, is just about a fifth of that size. So still a lot of room for that supply side reform to run.
All right, Bloomberg's China correspondent Min Lo there. Let's get back to the Bund summit in Shanghai now with our chief North Asia correspondent Stephen Engel. Steve.
All right, Paul. Jin Li Chun is our next guest. He is the AIIB president and chairman of the board. That, of course, is the Asian Infrastructure Investment Bank. Thanks so much for joining us. Always good to see you.
Thank you.
So how would you assess the best places or what the most pressing areas and sectors that the bank right now is looking to provide lending to? I mean, we all know that the new three in China's pursuit, Xi Jinping has talked about green technologies, obviously. So how much of what you're lending right now is into those green areas?
Yes, the mandate of Asian Infrastructure Investment Bank is to promote broad-based economic and social development through investment in infrastructure and other productivity. And so it is to improve investment in infrastructure, but infrastructure defined in a new, broad way. It's not simply just building roads, railways, airports. It is to build infrastructure for tomorrow with climate change mitigation adaptation taken into account, with the aim to empower women, to empower the vulnerable, so that all could benefit from the growth of those economies. That is the main objective. And you may have noticed that we have this corporate strategy approved by the board the year before the last, which sets the target of achieving climate change financing more than 50%. And by 2030, this is by 2025. We achieved that in 2022. And by 2030, the investment in private sector will be more than 50%. So these are the two new developments you probably have noticed.
Sure. I know your mandate to lend to developing parts of the world, including Africa. We just had FOCAC, which is the Forum on China-Africa Cooperation. And we all know African nations, many of them are in debt distress through COVID, and as well as with the high interest rates around the world, the high dollar, and the like. So many of these fiscally strapped African nations have been having a hard time paying off their sovereign debt loads. You're in a different situation, but probably face the similar challenges for repayment. How acute has it been for you?
You see, when the bank was set up, it was intended to be inclusive. Asian Infrastructure Investment Bank does not confine its business to Asia, because Asia cannot sustain itself without close economic trade relations with the rest of the world.
Yeah.
That is why we have regional members and non-regional members. As you may know, I just returned from a meeting in Cape Town, South Africa. And during the meeting here in Beijing with African countries, I called upon quite a number of presidents of those countries. As you know, Kenya has become a new member.
They're now, as of you met them, the president this week.
The president came to the bank. I met him earlier in May in Nairobi, and he told me he would speed up the whole process to make it possible for Kenya to be a full member. Now it's done. And also Senegal is moving forward.
Nigeria
is moving forward. And some other countries.
And South Africa has already ratified.
South Africa has already fully ratified. And we've done projects in Rwanda, we've done projects in Cote d'Ivoire, and we are planning to work in some other countries in Africa, because, you see, Africa will be becoming a very important region moving forward. I think the challenges faced by Africa is how to meet the basic needs of the people.
Yeah.
You know, 600 million people without access to electricity. How could we improve the livelihood of the people and at the same time protect the natural habitat for wildlife? So this is something we have to take care of.
How do you answer, though, to criticisms, whether it's loans that come from the China Development Bank or Export-Import Bank or even AIIB, that lending is not as transparent to these developed nations, underdeveloped nations, fiscally strapped nations, and this is the term that has been used, and believe me, I've been talking about it all week, about whether this is a debt trap. Is that just U.S. propaganda? How would you respond to that?
You know, I represent a multilateral development institution, so I cannot comment on anything for any special country. Sure. However, as a Chinese, and I can share with you the information I have, because I was also, when I served in Chinese government,
you were in the Ministry of Finance.
Minister of Finance. First of all, China is actually a newcomer in providing financing to the rest of the developing world. Developed countries did a lot of things ever since, let's say, the conclusion of the Second World War. And debt problems happened. First of all, I think the big ones is in Mexico 1980,
sure,
followed by a series of debt problems. China was actually, at that time, was not a major player in providing external financing. So you cannot blame China because of the debt problems. And then if you look at the way China is providing financing, normally at the request of the countries and helping them develop it. For instance, in Africa, local manufacturing capacity and providing support to agriculture and health, all kind of things. So I think we have to look at the facts and be fair.
But it makes sense, too, wouldn't you think, that China's moving essentially to a more mature model as far as development lending and wants better returns as well?
You may have noticed China is now paying more attention to the effectiveness of the financing in those countries, particularly in Africa. And it's not aiming at the big projects with massive investment. They look at the effectiveness of this financing, and also they focus very much on climate change, environmental protection, and social issues. We have, let me tell you, we worked with, for instance, China Exim Bank. China Exim Bank does not need AIIB's money. They have more money than we do. Why? Because they had the idea of working with this bank to improve the projects they finance in other countries, which means to enhance the governance, to improve the effectiveness of support.
But how do you see the interest rate environment, the changes, the pivot to an easing stance from the Fed, and also maybe the long king dollar run maybe is abating a bit? Is that going to help, you think, the refinancing as well as payment by these developing nations?
So far as the multilateral development bank is concerned, such as ours, we are less affected than probably some of the sovereign governments. But ours is triple rated institution. Now we intend to work in any external environment to raise funds at the lowest cost. Thereby we can help the countries to finance the infrastructure at affordable rates. So we watch the interest rate movement up and down very closely, but we have maintained our global presence in the international capital market. And so far, I can tell you that we are capable of providing low cost of funding to our developing member countries.
Jin Li Chun, thanks so much for joining us here at the Bund Forum. Hopefully you have some great fruitful discussions, and we'll talk to you next time.
Thank you.
Thanks so much.
Thank you very much.
Okay, guys, more from the Bund Summit here in Shanghai coming up.
Great stuff. Thanks so much, Steve. Now let's take a look at how markets are faring in Japan. Today, of course, is going to be all about the US job numbers and what this means for some of these bold bets, right? That some in the markets think we're going to get those 50 basis point in cuts in September, although most actually see a 25 basis point reduction as a more realistic expectation. And we're seeing against that backdrop how the dollar is weaker, and that has left the yen also rallying. We've seen these bullish yen bets, a fourth day of gains on the Japanese currency to the highest in about 8 months. And let's take a look at what this also means in terms of what we'll see in the markets potentially after the data is released. If you take a look at how there's been a spike in volatility, right? Overnight implied volatility has climbed to the highest since March 2023, and this was during the US banking crisis, which really spooked financial markets. So either way, whatever we get out of the data, we could see these huge swings. And for context, the data is going to be dropping right after Wall Street is done for the week and ahead of the Fed's blackout period. So suddenly a lot could go wrong. But flip the board, as we see the Japanese currency rallying, it's also putting pressure on Japanese equities. The benchmarks are down today. Some of the stocks in focus include the likes of Nippon Steel, and of course this is all deal related, as Biden is said to be preparing to block the deal, and this could leave the Japanese giant looking for other alternative growth opportunities. Seven & I, certainly another stock that we're keeping an eye on, as we have potentially it's saying, you know, all this takeover proposal, the price too low, and indeed I think we heard from the chairman of the board as well saying that the price that's been offered by Couche-Tard as it rejects this proposal has been opportunistic, grossly undervalues their path. Paul?
All right, thanks, Avril. Still to come, a closer look at India's labour sector as it struggles to create jobs for its expanding population. Analysis next. This is Bloomberg. Let's take a look at how Indian markets are tracking about 30 seconds into trade this Friday. And we've got a little bit of softness going on. The Nifty off by just a few points at the moment. The Sensex off by about 0.1%. This really reflects what we're seeing in broader Asia markets at the moment. We're really just tracking sideways ahead of those US non-farm payroll numbers. Well, India's surging stock market and growing economy are masking a key struggle There's a lack of quality jobs, especially for young and well-educated graduates. Our Bloomberg Originals team has been taking a closer look at this.
Hundreds of applicants, just a handful of openings. Sites like this one have become commonplace in India.
8-10 जॉब फेयर्स गए हैं, 4-5 कंपनी हो चुकी है हमारी जो है.
India's number of working age population is very impressive, but if you dig down to what the labor market is composed of, it shows a lot of weakness.
According to research, unemployment for those aged 20 to 24 has risen to over 42%. Just look at how the likelihood of being unemployed increases for young Indians the higher their levels of literacy and education are.
Private investments continue to be weak in India. A lot of people work in the agriculture sector, and these people have moved straight from the agriculture sector to the services sector, leaving the manufacturing sector behind.
Modi's government is aware of the importance of overcoming this challenge and has introduced measures to address it in its latest government budget. The measures include incentivizing employment in the manufacturing sector and a 5-year program to train 2 million people.
Unless we solve this, where the private sector feels like they want to employ more people and that there's a broadening of labor demand, we will continue to have the mismatch of youth who are now upwardly mobile to the reality of the labor market.
Well, let's dig deeper into this story with our South Asia economy editor, Rishi Bhatia, in New Delhi. So, Rishi, how many jobs is India going to need to create in the coming years?
Hi, Paul. Good morning. India's economy is growing at close to 8% every year for the last couple of years, but it is not creating enough jobs that are needed for its vast young force. By some estimates, India needs about 115 million jobs to be created by 2030. In fact, about 12 million people are entering the workforce each year, according to some estimates, and that shows how big the problem is. So much so that it is seen as one of the reasons why Prime Minister Narendra Modi lost a majority in the national elections that were held earlier this year. And Modi's first budget also focused in a great deal on providing jobs and skills as well. Having said that, if India does not provide enough jobs, it is staring at a big problem. It will not be able to reach the ambition of a developed country status by 2047. It will, it will not be able to provide opportunities for its vast young workforce. India wants to create a big middle class, but that will become a big challenge. People in the country will not be upwardly mobile. And besides that, the big concern also is the fact that this demographic dividend that India currently boasts of, and that could very well be a very well become a demographic curse, is what experts say. What they also tell us is that right now India talks about this big market, which is usually used as a way to attract big companies like Apple. And if these people are not earning well enough, then who will really buy all the products that these big companies are making? So providing jobs is, the number one priority that the government should focus on at the current moment.
Rishi, what about why students specifically are unable to get good jobs? Where is the weak link here?
I would say the weak link is the fact that India is not being able to provide vocational training to its vast young workforce. Also, the level of education in India is not very good. In fact, the ILO report recently said that almost the number of graduates who are not able to get jobs is almost 9 times as higher as the ones who have not studied at all or who don't have any basic level of education. And it shows the fact that India needs to work on its education sector as well in a big way. Having said that, providing skills is also very important. You can get the likes of Apple and Foxcons into the country, but you also have to provide a skilled workforce so that these companies can employ people in their factories. India also needs to focus on its small and medium enterprises because that's where the large workforce can work. some experts do say that big companies don't really hire as many people. So one really has to bank on the small and medium enterprises. And besides that, the government has to get the animal spirits back in the private sector so that more and more jobs can be created.
All right, South Asia economy editor Ruchi Bhatia there. Staying with India, India and Singapore have agreed to ramp up collaboration in digital technologies, seeking a bigger role in global chip supply chains. Prime Minister Narendra Modi was in the city-state as agreements were signed to cultivate talent in chip design and manufacturing and boost Singapore tech investment in India. The tie-up showcases Modi's ambition to turn his country into a technology superpower. Plenty more to come. This is Bloomberg. Here are some of the top corporate stories that we're following. Bloomberg has learned Intel is weighing a sale of part of its majority stake in Mobileye as part of a major strategy overhaul to improve performance. Sources say Mobileye has a broad board meeting later on this month where Intel plans are going to be considered. Shares of the struggling automated driving systems provider slumped in US trading. Software billionaire Larry Ellison will take control of Paramount Global after a group led by his son David completes its purchase. The Oracle co-founder is backing his son's $8 billion proposal, and a filing shows he'll take almost 78% of the Redstone family's interest in the film and TV company. Sources tell us that Shari Redstone will get $180 million in severance and benefits from the deal, on top of hundreds of millions more from the sale of her stock. All right, let's take a look at how markets are tracking. We have been watching closely the bond space in China as yields continue to slip to new lows. And there you see the yield on the China 30-year at the moment. China's finance ministry selling 30-year special sovereign bonds at an average yield of 2.3641. This is according to a trader that bids at government debt auctions. The planned auction size on 30-year special sovereign bonds, 45 billion yuan. That's versus 44 billion yuan in the previous issuance. So there you see the yields on China's 30-year continuing to slip lower. Here's a look at how we're tracking on global markets. Meanwhile, really good day for Thai stocks, perhaps the best day that we've seen since 2020. Policy risk appears to be abating in Thailand. We've got a little bit of weakness elsewhere. However, most of the major indexes in the Asia-Pacific bit weaker right now. We've got the Nikkei off by 0.5%, the Kospi by 0.75%. Almost as if we're waiting for something, right? Yeah, US non-farm payrolls for the month of August. We're really holding our breath for that as it's going to dictate the next move for the Fed. There you see Hong Kong, no trading there today. We are on hold there due to Typhoon Yagi lashing the city. That is it. Bloomberg Markets Asia, Horizons Middle East and Africa up next.